Parties to an insurance contract. When discussing ethics in insurance, the first topic is typically the contract itself. The primary parties to an insurance contract are the insurer, the insurance company that takes on the risk, the insured, the policyholder or contract owner who holds all the contractual rights. These rights include the ability to name or change a beneficiary, cancel the policy, and increase or decrease the premium. The insured can be a natural person, an individual, or a legal person, a corporation. The life insured. This is the natural person whose life is being insured. Corporations cannot be life insured because they do not die or become disabled. The beneficiary is not considered a party to the actual contract. Their role is to receive the money from the death benefit. Types of insurance based on parties. Personal insurance. This occurs when the insured and the life insured are the same person. The insured still holds all contractual obligations to third-party insurance. This occurs when the insured and the life insured are different people. An example is a group insurance plan, where the sponsoring company is the insured and the employee is the life insured. Beneficiary designations. Beneficiaries are the individuals or entities that receive the death benefit from an insurance policy. While they have the right to file and contest a claim, they are not a party to the insurance contract itself. Types of beneficiaries. Estate. Naming an estate as a beneficiary means the death benefit is paid to the estate. This money is initially tax-free but becomes subject to creditors and potential taxes once it enters the estate. This can increase the estate's value, leading to more taxes and creditor attacks. Persons/group of persons. Naming a person or a group of people like all my grandchildren as beneficiaries allows the money to bypass the estate, providing protection from taxes and creditors. Business/partner. A business or partner can be named as a beneficiary, for instance, in a key person insurance policy to protect the company financially. Trustee. A trustee can be named as a beneficiary to manage funds on behalf of a minor or someone who is unable to manage money themselves. The trustee will manage and disburse the money according to the directions you provide. Beneficiary classifications. Revocable beneficiary. You, as the insured, can change this designation at any time without notifying the beneficiary, who has no rights under the contract. Irrevocable beneficiary. The beneficiary becomes a party to the contract, and you cannot change them, cancel the policy, or borrow against it without their consent. This is often used in cases of divorce settlements to ensure child or spousal support. It can also be used to protect a non-preferred class beneficiary from creditors. Preferred class. This class includes a person's spouse, children, grandchildren, and parents. Naming a preferred beneficiary, even if revocable, provides creditor protection, as the money is non-accessible to creditors. Absence of a beneficiary. If a beneficiary dies before the insured, or if no beneficiary is named, the death benefit is paid to the insured's estate. To avoid the money being subject to creditors and taxation in the estate, it's recommended to name a contingent or secondary beneficiary. In a situation where it's unclear who died first, it is presumed that the beneficiary died first. Impact of divorce on beneficiary designations. A divorce does not automatically negate a beneficiary designation. The insured must notify the insurance company in writing to change the beneficiary, or the ex-spouse will still receive the funds upon the insured's death. Policy assignments. A life insurance policy can be treated as a piece of property that can be assigned. There are two types of assignments. Absolute assignment. This involves the transfer of policy ownership to another party, such as a charity. The original owner loses all rights and control of the policy. It is illegal in Canada to sell a policy for cash, but you can willingly transfer it. This type of assignment may trigger a tax implication on cash value policies. Collateral assignment. This does not transfer ownership but places a lien against the policy for a third-party lender, like a bank, to secure a loan. If the insured dies with an outstanding loan, the lender is paid first from the death benefit, and the remaining balance goes to the beneficiary. This type of assignment does not trigger tax implications because there is no disposition of the policy. Temporary Insurance Agreement, TIA. The Temporary Insurance Agreement, TIA, is a separate legal agreement issued by an agent when a client pays at least 1 month's premium with their application. The TIA provides coverage to the client if they die during the underwriting process, before the formal policy is delivered. Key aspects of the TIA. Issuance conditions. The agent can issue a TIA if the client pays the first month's premium and the agent has no reason to believe the client is being untruthful about their health. Coverage. The TIA is in effect as long as the insurance company would have issued the contract as a standard. It is not a guarantee of coverage, and if something is discovered during underwriting that would prevent a standard contract, the TIA can be cancelled. The TIA will pay the lesser of the amount applied for or the maximum amount specified by the TIA itself. Duration. A TIA typically has a 60-day expiry date, though some companies may have a 90-day period. If underwriting takes longer than the TIA period, it may be cancelled. Purpose. The main purpose of the TIA is to provide peace of mind to the client while their application is being processed. Contract termination and claim denial. An insurance company can terminate a contract or deny a claim for several reasons. Material misrepresentation. This occurs when a client makes a mistake that, had the company known about it, would have resulted in the policy being issued differently, e.g., as substandard. If discovered within the first 2 years, the contestable period, the contract can be voided. After 2 years, the policy becomes incontestable. Fraud. This is an intentional act of deceit. Unlike misrepresentation, there is no statute of limitations on fraud, and a contract can be voided at any time if fraud is discovered. Examples include lying about a heart attack or forging a signature, non-payment of premiums. Failing to pay premiums will result in a policy lapsing. Most policies have a 30-day grace period, while universal life policies have a 60-day grace period to payment against public policy. An insurance company will not pay a death benefit if the death occurs during an illicit act or if the beneficiary murdered the life insured. This is because paying out would violate public policy. In order for a life insurance claim to be paid, the insurance company must first receive a notice of claim, which is a notification that the insured client has died. The company will then require specific paperwork as proof of claim. This includes a death certificate, which serves as proof that the person has died, proof of age, to ensure that the age on the policy is correct. If a mistake was made, the insurance coverage amount will be adjusted to reflect what the premiums would have bought at the person's actual age, proof of identity, to confirm the deceased person is indeed the life insured on the policy, proof that the death was a result of an accident, if the policy includes provisions for accidental death benefits. The insurance company may deny a claim under certain circumstances. Suicide is not considered an accident and is typically not covered in the first 2 years of a policy. The company may also deny a claim if the death was caused by an activity or hobby that was explicitly excluded in the contract, such as scuba diving or skydiving. The beneficiary, or claimant, must provide proof of their identity and that they are the rightful beneficiary to receive the payout in cases where a client disappears and there is no body. A claim cannot be filed immediately. The insurance company will typically wait 7 years, after which a court can declare the individual legally dead. However, if there are circumstances that suggest a presumption of death, such as a boat capsizing or a plane crash, a court may declare the individual dead sooner than 7 years, even without a body. The purpose of these measures is to prevent fraudulent claims and ensure the correct person receives the funds. FINTRAC's main purpose is to help detect and deter money laundering. When a client wants to open an account or purchase an insurance product through their company, it is necessary to first confirm the company's existence. To do this, you must obtain and keep a copy of at least one of the following documents: a certificate of incorporation, a certificate confirming the legal corporation's existence, a document filed annually under provincial securities legislation, or any other document that proves the company exists. There are a few ways to verify a client's identity. Photo ID. You must ask to see a valid, original photo ID, such as a driver's license or passport. The name on the ID must match the client's name. Credit report. The credit report you pull must have been in existence for at least 3 years. The name, address, and date of birth on the report must match the information provided by the client. Equifax is a common source for this. Dual process. This involves using the original versions of 2 different documents. The client's name, address, and date of birth must match on both documents. The purpose of these verification methods is to ensure that the client is who they say they are. If a client is opening an account for someone else, a third-party determination form must be filled out. Any suspicious transaction or attempted suspicious transaction must be reported to FINTRAC immediately. This includes situations where a client seems odd, asks strange questions, or stops a transaction partway through after you start asking for more information. The duty to report applies even if the transaction is not completed. Failure to report suspicious transactions can lead to criminal charges, as it is seen as helping the client deceive the government. The information you report is confidential. Examples of suspicious transactions include: a client refuses to provide personal identification documents. A client is unusually interested in the cancellation of a product, such as asking about the cancellation procedure for a whole life or universal life policy shortly after purchasing it. A client provides a P.O. box address instead of a street address. A client attempts to create an unnecessarily complicated transaction plan. In the event of an insurance company failure, Assuries acts as a safety net to protect consumers. While there have been no failures in Canada since 1993, and in past cases, other companies have taken over the business to ensure no clients lost money, Assuries provides assurance just in case something were to happen. Assuries provides different coverage amounts depending on the type of product. Death benefit. 85% of the covered benefit, with a minimum of $200,000. For benefits under $200,000, the coverage is 100% health insurance. 85% of the covered benefit with a minimum of $60,000. This includes extended healthcare and travel insurance. Monthly income. 85% of the covered benefit, with a minimum of $2,000 per month. This applies to products like annuities and disability insurance. Cash value insurance. 85% of the cash value, with a minimum of $60,000. This includes universal life and whole life policies. For cash values under $60,000, the coverage is 100% at segregated funds, 85% of the guaranteed amount, with a minimum of $60,000. For a deposit, the coverage is up to $100,000, similar to CDIC protection for bank accounts. Professional practices are guided by several key principles. Duty of care. This means acting as a reasonable person would under the circumstances, always putting the client's interests first. This includes ensuring the safety of the environment where you meet with a client. Integrity. This involves being honest, fair, and forthright with clients. You must follow through on your commitments or inform the client if you are unable to. Competence. Clients have a right to expect that you are knowledgeable in your field. This requires keeping up with continuing education, such as the 30 hours of credits required every 2 years in Ontario. You should not present yourself as something you are not. These 3 principles are encompassed by the broader concept of acting in good faith. Conflict of interest. This occurs when you prioritize your own interests over those of your clients. For example, if you recommend a product because it will earn you a trip, you must disclose this to the client. You should also avoid situations where you would benefit personally from your client's assets, such as being a power of attorney or trustee. Product suitability. You must recommend products that genuinely fit the client's needs, not your own. A thorough analysis of the client's situation is required to make appropriate recommendations. Tied selling. It is illegal to make the sale of one financial product conditional on the purchase of another. Each product must be sold on its own merit. Commission splitting. You can split commissions with another licensed agent. However, it is illegal to split a commission with an unlicensed individual who provided a lead or helped with the sale. Referral fees. You can pay referral fees to organizations that provide leads, as long as they are not in the insurance business themselves. The fee cannot be conditional on a sale being made. The fee should be a reasonable amount, typically no more than $50. Rebating. It is a clear violation to induce a client to buy a product by sharing a portion of your commission or paying for part of their premium. This is considered deceptive because the client is not buying the product based on a clear understanding of its cost. This can lead to fines or the loss of your license. Forgery and fraud are criminal acts that involve an intentional act to deceive. You should never forge a client's signature, even if it is inconvenient to get it in person. If you miss a signature, you must contact the client and inform them that their coverage is not in effect until they sign the documents. There is no statute of limitations on forgery and fraud. Trafficking, also known as a life settlement or viatical, is illegal in Canada. This is when you buy a client's life insurance policy, typically from an elderly or financially distressed person, in order to become the beneficiary and collect the death benefit when they die. It is considered taking advantage of a vulnerable individual. Fronting is when a licensed agent acts on behalf of an unlicensed individual who has written an application. The licensed agent signs the application as if they witnessed the client's signature, even though they did not. This is a violation of the act. Delaying the delivery of a policy is a serious issue that could jeopardize your client. Many companies state that a policy is not in force until it is delivered. If a client's health or other circumstances materially change between the time the application is submitted and when the policy is delivered, you cannot deliver the policy. Misrepresentation occurs when you make false statements about a product or company that are not true. This can lead to a client's expectations not being met and can result in trouble for you. Commingling of funds happens when you deposit a client's money into your personal bank account instead of forwarding it directly to the insurance company. This can create a situation where it is unclear whose money is being used to pay the premium. To avoid this, you should have a separate trust account for client money. How you hold yourself out to the public is very important. You should not advertise yourself as something you are not, such as a financial analyst if you only sell mortgage insurance. Your business cards and website should accurately reflect your credentials and what you do. Churning and twisting are terms for replacing an existing insurance policy. Twisting is replacing a policy with a product from a different insurance company, while churning is replacing it with a new policy from the same company. While not inherently wrong if done properly, replacing a policy restarts the 2-year contestability and suicide clauses, which could leave a client and their family vulnerable if something were to happen. To protect yourself, you must file a Life Insurance Replacement Declaration, LIRD, form, which outlines why the replacement is in the client's best interest and is signed by the client. You should keep a copy for yourself and give one to the client. Errors and omissions, E&O, insurance or liability insurance, is a crucial requirement for all licensed agents. The minimum requirement is at least $1 million in coverage. If you suspect you may be sued, the first thing you should do is notify your E&O company. They will open a file for you and assign a lawyer to help you through the process. All life insurance contracts in Canada have a 2-year contestability period, starting from the policy's issue date. During this time, the insurance company can contest the policy if they find any material misrepresentation. For example, if a client dies during this period and the company discovers they lied about being a non-smoker, the company can void the contract. After 2 years, the policy is considered incontestable, with the exception of fraud, forgery, and theft, which have no statute of limitations. When a policy is replaced, the contestability and suicide clauses start all over again. This means a client could be left without coverage if they die by suicide within 2 years of the new policy being issued. To protect yourself from liability, it is essential to use a disclosure form, like a Life Insurance Replacement Declaration, LIRD, to inform the client of the provisions of the new policy and get their agreement.